Hey there, everyone. This is Deeksha Janiani, and I'm representing Team Trendline. This week, we discussed the financial performance of new age companies like Paytm, Zomato, and Nykaa, and the future growth strategies that are on the cards. These companies actually went on to lose over 29% of their value since listing as on June 1st, 2022. And now let's get to the annual financial performance of these companies. These companies grew their revenues at a 3-year compounded annual growth rate, which is CAGR, of more than 35% on an average in FY22. And that is the kind of growth rate you also expect startups to clock given their ability to scale up faster on account of the funding that they have. And however, their net profits continue to be in the negative zone. In fact, their net losses magnified even further in FY22 compared to FY21. Companies like PBFintech, which is Policybazaar, saw its losses magnified by over 5 times to 830 crores. And the one company that had profits in FY21, which is Nykaa, saw its profits fall by over 30% in FY22. Now, another important point. So they say that it's all about cash flows, isn't it? There was a discussion about positive cash flows around the time when these companies were planning to go public. In fact, companies like Nykaa, PV Fintech had positive cash flows to show in FY21. Even a company like Paytm had positive cash flows of 330 crores in Q1 FY22. However, post their listing, the cash flow sunk into the negative territory. Nykaa clocked a negative cash flows of 350 crores because of inventory buildup, and Paytm also saw its cash flows going in a negative territory to the tune of more than 1200 crores. In fact, a company like Zomato clocked negative cash flows of over 3800 crores in the past 3 years cumulatively. And this is despite the fact that pandemic worked to the advantage of food delivery companies specifically, because the dine out restaurants were closed during that time. Again, a point to note for you there. So moving on, so let's see how these companies did after they got listed. So coming to Nykaa. So Nykaa grew its revenues by over 30% year on year to 970 crores in Q4 FY22. However, its revenues actually fell sequentially. So because see, Q3 FY22 is generally a strong quarter because of the weddings and festivities happening in that quarter. However, the dip in discretionary spendings on account of commodity price inflation also hit the company's revenues and ultimately its margins. So, see, the company noted that there were many weddings that faced downsizing in the quarter. And in fact, there were many Indian weddings that were postponed to Q1 FY23 because of the third pandemic wave. And see, beauty expenses are actually directly correlated to the wedding ceremonies in India. And that is the reason you also see the average order value falling over 12% sequentially in Q4 FY22. So, moving on. See, the higher marketing spends have ultimately dragged the company's margins. See, as a matter of fact, company's beauty segment maintain its margin levels at 8%. However, it's the negative margins of the fashion segment and new business initiatives which ultimately dragged the overall margins to 4% levels in FY22. That's right. Moving on to Paytm. So Paytm grew its revenues by over 85% to more than 1500 crores in Q4 FY22, led by payment services and merchant services. So growth in gross merchandising value from merchant discount rate bearing instruments like Paytm wallets, debit cards, and credit cards ultimately led to the growth of the payment services division. Now, the growth in credit card swap machines to 2.9 million in Q4 FY22 from 0.8 million in Q4 FY21 also led to the growth of the merchant payment services division. So the company is also, involved in lending, in granting postpaid loans, personal loans, and merchant loans via its tie-ups with NBFCs, and it earns a commission on that. So it's not undertaking any credit risk, but it's actually acting as a distribution platform. So ultimately, company's lending book grew over 5x, driven by its postpaid loans, which ultimately added to the revenue growth of the division as well. So ultimately, companies being bogged down by its higher employee costs, in turn led by the higher ESOP costs. So companies actually building its sales team so that it can onboard more merchant onto its platform. So you can clearly see the upward trajectory in the employee cost there. So ultimately, in this race to scale up, the company is compromising on its profitability, and it continues to clock operational losses even in Q4 FY22. So moving on to Zomato. So Zomato saw its gross order values jump to 5,800 crores. It actually jumped by over 75% to 5,800 crores in Q4 FY22. However, it made less money on each of the orders because its contribution margins were lower at 1.7%. So you see, contribution is one thing that you basically derive by deducting variable costs like employee expenses and delivery expenses from revenue. Company actually had a negative contribution margin in back in FY20. And see, viewers should note here that contribution is something that you don't need to disclose as per the accounting standards. It is something that companies disclose for investors when they are clocking heavy losses. So that's one interesting bit for you. So moving on, the company was actually hit by higher delivery costs. The company has actually not passed on the burden of higher petrol and diesel prices onto its consumers, which is why its delivery costs shot up and which ultimately impacted the margins of the profitability of the company. So company is also not in a hurry to, turn profitable anytime soon. It's actually taking comfort from the fact that it has cash of more than 12,000 crore at its disposal, according to a report by Daulat Capital. So yes, that's one fact for you. So now let us discuss what are the future growth strategies being employed by these companies. So Nykaa is actually betting big on the fashion business now that it has clocked profits in the beauty business. So it sees the online fashion market to be 5 times bigger than the beauty market. However, we cannot discount the fact that there is a Walmart backed Myntra, there is a Reliance backed Ajio present in this place, and they are well established companies. And see, the company Nykaa doesn't have a first mover advantage in this space as it had in the beauty and the personal care segment. So one more point out there. So this makes us wonder the need for the company to grow big in a already crowded space. See, companies also seeing the competitive intensity of the beauty space reducing. So that also makes us question on its capital allocation policy. The company is actually compromising in its margins to grow its fashion business. In fact, the monthly average unique visitors on the fashion portal were at static at 16 million in the last 3 quarters. So that's one fact for you. Another thing is that on the beauty front, the company is trying to build more regional warehouses so that it can reduce its fulfillment cost and get nearer to the customers. The company actually made 2.4 lakh square feet of warehouses, up 40% year on year in FY22 to achieve this objective of its. Moving on to Paytm. So see, over the years, the merchant discount rate, basically the commission that Paytm earns on the payment services, have reduced because of the advent of unified payment interface and high competition in the space. So the company is now betting big on the lending space because this is one space it can achieve higher scale and it can earn positive contribution margins in the space as well. However, needless to say, this space was also extremely competitive because you have banks, you have fintech companies, you have NBFCs already vying for the borrowers here. So that's one fact for you. So company was actually planning to obtain a small finance bank license in May 2022. But RBI actually banned the Paytm Payments Bank to onboard new customers via wallets and via CASA accounts. So until and unless the company resolves RBI's directives and the issues observed, the chances to get that license are very slim. Even if it does get the license and it scales up the loan book very fast, there can be issues on the asset quality front as well. So that's one thing for you there. And see, one more thing is that the company intends to turn EBITDA positive before ESOP cost by September 2023 quarter. Yes, you heard that right. So moving on to Zomato. So Zomato is betting big on the quick commerce space. The company is actually planning to invest over 3,000 crores in this space by 2023. For this purposes, it acquired 10% stake worth 740 crores in Blinkit, which is a quick commerce space in the grocery delivery segment. In fact, it also gave a working capital loan of more than 1150 crores to this company. So that's one more thing also. See, Blinkit, which was the erstwhile Grofers, has been present in India since 2013 and 2014, and it has not been able to successfully scale up itself, and many of its stores in multiple formats have also closed down. See, there is and it has also burnt the cash that it received since 2021 in trying to make the 10-minute delivery model successful model. And it's a known fact that many quick delivery startups have actually failed in India because the margins in this business are less. There are higher marketing heads, and there is also a problem of attrition amongst the delivery personnel. So that's one issue for you there. Other thing, the company is actually not, it needs 5% contribution margin to break even in the food delivery business. Its hyper pure business is, operating on negative gross margins, yet it intends to invest in a quick commerce business with no sight of profitability and no timeline to achieve the same over a period of time. So basically, the objective here for startups is to grow fast, scale up faster, with no urgency to clock profits. So investors can, believe, go on to believe in this story until unless there's a gold at the end of the rainbow. So that was my time, folks. Thank you so very much, and have a great.